All right. Welcome everybody to today's webinar, How to Develop a Profitable Trading Strategy. My name is Markus Heitkoetter. I'm the CEO of Rockwell Trading. And this is actually the third part of our series, Profitable Day Trading in the Forex and Related Markets. And I want to thank fxtrade.com for having me here today again. I'm here every first Tuesday of the month, and in between, I'm also conducting a couple of premium sessions. And guys, isn't it beautiful to be a day trader? Right now, I'm greeting you from the beautiful white beaches in South Padre Island. So I've been taking a week off, but with this technology, you can still trade, in fact, here really from a beach and even conducting webinars. Anyhow, I try to be as focused as possible here, answer all your questions, and walk through the presentation before heading back to the beaches. All right. As I said, we want to get started today with our webinar, How to Develop a Profitable Trading Strategy. It is so important for every trader that you have a sound trading strategy. And recently, we released our trading plan navigator that is available through our website, and I'll talk about it a little bit for just a minute towards the end of the presentation. What we'll do today is basically I'll walk you through the 7 steps how to develop a profitable trading system. At first, we start with an idea. Then we select a market. We select a time frame. The 4th step, defining the entry rules. In the 5th step, we are defining the exit rules. Then we evaluate your system, and if needed, we improve our system. And we'll talk about all these 7 steps today. What we're going to do today is that we walk through the system, the theory behind it. And when we're coming back in the beginning of September, the first Tuesday in September, we'll use these 7 steps to actually develop a system. So it's basically, yes, we have a multi-part series here, and this is basically a 2-part mini-series within the series. So today we walk through the 7 steps, and the next time we will use the 7 steps to actually develop a profitable trading strategy. All right. One very common misconception. Traders think if they just had a good trading strategy, that this is the guarantee to make money. Guys, that is not true. You know that there are probably hundreds or thousands of trading strategies out there. And yes, in fact, most of them actually work. But according to the NASAA, only 11.5% of traders are successful. So you need to ask yourself why. And if you have been listening to previous webinars, you know that there is more to trading than just having a profitable trading strategy. However, we have in previous webinars talked about the 6 mistakes, and you can watch the recordings here on fxtrade.com if you have missed one of the webinars, and you know that the number one reasons why traders lose money in the market is the lack of a trading plan, the lack of a trading strategy. And that is why today's session is dedicated to develop a successful, a profitable trading strategy. You've heard the other mistakes, so I don't want to go over them again. Let's dive right into and let's talk about the step number 1, how to develop a trading system. You see, a trading system, a trading strategy is a step-by-step systematic approach. It's not as difficult as you might think or as many other people might want you to think out there. You have basically 2 common approaches. You either have a trend following strategy or a trend fading strategy. And there are many forums out there. You have a forum here on fxtrade.com. There's elitetrader.com. There's Trade to Win. So there's a plethora of information out there about profitable trading strategies. Also, if you do need some ideas, you might want to catch James Altucher's book, Trade Like a Hedge Fund, in which he presents, I think it's 21 uncorrelated trading strategies. However, as you will see, and this is why the 2nd and 3rd step is to select a market and a time frame. Depending on the market and the time frame, you might use a different trading strategy. Also, your account size, your preferences regarding risk and reward, and many other factors might affect the trading strategy that you choose. Because if you remember a slide back, the second reason why traders lose money in the market is because of the lack of discipline to actually follow a trading strategy. You see, The reason why traders do not follow their trading strategies is because they're not comfortable with it. Make sure that at first you write down your goals. How much money do you want to make with trading? How much money can you put in your trading account? Believe me, you trade a $5,000 account differently than a $500,000 account, or maybe even a $2 million account. A $5,000 account, you trade more aggressively. You want to double and triple it, maybe quadruple it. If you have a million or $2 million account, you might just look for 30 or 40% a year. Also, you might have a problem applying successful day trading strategies if you want to place like 500 or 600 lots in the market if you're trading futures markets like the mini S&P. See, all this influences the trading strategy, and this is why at first look at a variety of trading systems here that are out there. Get familiar with this, get comfortable with them, try to understand what they are doing. So let me see, there's a question here that the sound is really soft. Let me just make sure, because previously we adjusted it and it should be good and fine. You should all hear me fine. Maybe, Abel, you have to re-log in. I hope that this might solve the problem here. Okay. Now, selecting a market, you know that you basically have three markets. You have the futures market, you have the stocks market, and you have the forex market. On futures and stocks, you could also trade options. Options on futures and options on stocks. So these are basically your options. So what are the differences between these markets? And again, it is very important that at first you determine your risk preferences, what you want to do. Because let me give you an example. Let's look at stocks, for example. With stocks, you have a rather low leverage. There are thousands of stocks to choose from, so it might be tricky. It might become a challenging task to find the right stock to trade. And if you want to day trade, then you need to know that you need at least $25,000 in your trading account. So for many of you, this might not be an option. Well, in the forex markets, you know that you have no commissions, that you get free data, but also that you have a spread of 2 to 5 pips, depending on the forex broker that you choose. Now, if you're trading extremely small time frames, and we'll talk about this on the next slide, the smaller the time frame, the smaller the average profit and also the average loss. But therefore, you might not, or you cannot afford paying a high spread here. You might just go for 2 or 3 pips. And you see, this is a little bit difficult scalping in the forex markets because you have a 2 to 5 pip spread. So if your trading strategy is rather a scalping strategy, you might want to look at the futures markets where you have a high leverage. Yes, you do pay commissions, but there are low commissions and also low margin requirements. But if you're new to trading, if you have never traded before, the forex market has some advantages because there are mini accounts available. You see, as a trader, you should start trading your strategy at first, of course, backtesting it, then on a paper trading account, and then you might get started with a mini account. To get started here, to see how the mechanics work, to place orders. And you see, on a mini account, it is usually that every pip is the equivalent to $1, where on the regular account, every pip is the equivalent to $10. So you can get started with sometimes as little as $500 and try to get your feet wet. However, do still take it serious, trading. I mean, trading is a profession, and we have dedicated other webinars to this topic. All right. Let's move on. Selecting a time frame, because we have a lot of information here, and I want to make sure that I give you all the information that we have here, and also that we have some time for some questions here towards the end. Step 3, selecting a time frame. Well, actually, there are 3 types of trading. You have the long-term trading, where you hold a position a couple of weeks to a couple of months. You have short-term trading, where you hold a position a couple of days to a couple of weeks. And we have day trading, where we can send minutes to hours. And the administrator just tells me that we need to send the images again. We don't see it. So actually, you all should see right now step 3, selecting a time frame. Let me just quickly do this. We have gone through approximately 10 slides so far. I hope that you caught the slides. Moderator, let me just ask you, is that okay? Do you see step 3, selecting a time frame right now? The images were fine. Great. I just want to make sure, since this is recorded, that also the moderators see all the images here. All right. Thanks for the feedback, guys. Really appreciate it. Now, in short-term trading, you hold a position a couple of days to a couple of weeks. And in day trading, you hold a position a couple of minutes to a couple of hours. Again, You see, your personal situation might influence what kind of trading you want to do. If you don't have the time throughout the day to watch the market, then day trading is not for you. Because in order to succeed with day trading, two conditions have to be met. First of all, you have to be ready, and second, the market have to be ready. It doesn't work like that, that you say, for example, in the evening at 7 p.m., oh, okay, I have an hour, and now I can trade. And you hope that the market gives you some fantastic opportunities. You see, you have to see, especially if you're trading currencies, you know that you have a small window when the currencies are really moving, and this is when the underlying interest rates are moving. For example, all times right now are specified in Eastern Standard Time, New York time. If you're trading the euro versus the US dollar, usually you see pretty good trading opportunities between 3 a.m. to 7 a.m. in the morning, and then again from 8 a.m. to approximately 1 p.m. New York time. After 1 p.m., you will see that if you're trading the euro versus the dollar, that the market is rather flat and not really moving. And we'll talk about this here in a minute. The best markets to trade are trending markets because trend following systems are usually more rewarding than trend fading systems. And this is actually the next step. However, as you can see, so if you're fixed on the euro versus the dollar currency, but you only have time to watch the market in the evening, Eastern time, then this market is not for you. You might want to switch over to trading the Japanese yen because the Japanese yen usually provides some opportunities around 9 p.m., 10 p.m. Eastern Standard Time until early night then. So you got to consider a few things, and this is where sometimes you might have to switch over to short-term trading where you hold a position a couple of days to a couple of weeks. Now, you need to know that the smaller the time frame, the smaller the average profit per trade, and the smaller the risk. Let me give you an example. If you are trading on 5 to 15 minute charts in the euro versus the dollar, you can usually get away of a stop loss of 10 maybe to 15 pips, maybe go up to 20 pips, somewhere around that. Also, on the other hand, your profit target is usually 1.5 to twice as big, so you can have a profit target of anywhere between 20 and 40 pips. Now, as you can imagine, if you are trading on daily charts and you're applying a 10 pip stop loss, you're getting stopped out immediately. On daily charts, you might have to use a stop loss of anywhere between 60 and 120 pips, depending how long you want to stay in there. You see, this is how it works, and this is why usually I do not recommend trading the Forex market on 1 minute charts. Because of the spread that you're paying here, the average profit is not big enough that you can make, and the spread is basically eating up all your profits. Many profitable trading systems use larger time frames, especially if you look in the books of James Altucher or Thomas Stritzman, who are suggesting here some trading strategies that are holding a position a couple of days or a couple of weeks. They have an extremely high reward. You'll see that you can make hundreds of thousands of dollars on each trade. But on the other hand, as I just said, you also have a higher risk because you have to use a larger stop loss. Therefore, you might experience a larger drawdown, and of course, you need to understand if you're trading on daily charts that you are having less trading action. You might just have 1 or 2 trades per day. So, if you are a beginner, I recommend that you start off with a small time frame to get your feet wet, and then later on move on to a larger time frame if you can stand a larger drawdown. Okay, so here comes the meat: entry rules and exit rules. This is the very important part of this section, and this is why we're going to. So we have plenty of time. Perfect. Well, we can dedicate some time here and I can show you some examples. Entry rules, as I said previously, all the indicators that are out there and all the systems that are out there belong to one of the two categories. You either have a trend following strategy or a trend following indicator or a trend fading indicator or a trend fading strategy. I have yet to see a trading strategy that works equally well in trending and non-trending markets. I know that some people claim they have a so-called hybrid system that works in both markets. but you will see that it does better in under one certain market conditions. So either when the market is trending or when it is going sideways. This is why, again, you should not apply a trend following strategy all day long in the markets, because there are some times when the markets have beautiful trends or when the likelihood of trends is higher, and then there are times when you know that the markets are not moving. For example, in the euro versus the dollar after 1 or 2 p.m. Eastern Standard Time. The markets are just flat for the next 12 hours and only move a little bit up and a little bit down. What you should do during that time is apply a trend fading strategy. So very briefly, as you can see here, how it is defined: trend following: when prices are moving up, you buy, and when prices are going down, you sell. That is trend following. Now, trend fading means that when prices are trading at an extreme, for example, at the upper band of a channel, or for example, at a resistance level, then you would sell and you would. Okay, so the sound is back. Well, where did you lose me? Just want to make sure. It seems that you just lost the last sentence here. Okay, so the last sentence that I said probably when we lost the sound here is where it said, if you approach a resistance level, for example, the previous day high, using a trend following approach, you would then buy, assuming that prices would break above the previous day high. Using a trend fading approach, you would sell, hoping that the resistance level holds. Make sense? All right, let's move on and let's take a look at some approaches here. Very popular approaches for trend following and trend fading, and I have a couple of examples of these approaches here on the next slide, are breakout trading, the so-called turtle trading. I don't really have an example for this because there's a plethora of information out there on the internet. You know that the original turtles formed around Richard Dennis, and I think it was years and years back, wasn't it in the 80s? Richard Dennis basically took a group of people and let them trade the commodity market. I do believe, as far as I remember, it was on daily charts or 60-minute charts. The way how it went is that you display a chart and then you determine the high of the last 20 bars. Once prices break the high of the last 20 bars, the turtles bought, and the same applies for selling. So a typical breakout trading, they were defining a range, and when prices broke above the range, then they actually bought. Typical trend following system. They applied very rigorous stop loss rules, and you find the rules for free on the internet. You just type in turtle trading rules and you'll see them. There are PDF documents out there. Moving averages and the crossover of moving averages, definitely a trend following approach. And you need to understand this. This is why many people say, well, I cannot successfully trade moving averages. I'm getting whipsawed. Well, if this is happening, then you are applying a trend following approach in a sideways moving market. Guys, it is so important that you learn the basics about trading. You need to learn to read a chart and tell me at any given moment whether the market is going up, down, or sideways. So you need to see whether the market is trending or going sideways, because based on that, you will apply the proper trading strategy. All right, another trend following approach is parabolic. Then we have trend fading approaches. Many oscillators like the RSI, Larry Williams percent R, are trend fading oscillators, trying to identify overbought or oversold situations. So if a market is reaching an absolute or relative high, you start selling and hope that prices make a small correction here. Bollinger Bands are actually a hybrid trading system, and Bollinger Bands can be used for trend fading and trend following. However, the most popular approach to use Bollinger Bands is trend fading. And then another trend fading approach is that you could simply sell highs and buy lows, sell the previous day high, sell a 52-week high, sell a week's high, and buy low. So let's take a look at some examples here. So here's an example of the crossover of moving averages. You see on the chart, and actually what you want to do, it doesn't really matter what the underlying market is here. You just plot them in a certain time frame. So the time frame that I've been using here is 60-minute bars, and you have two types of moving averages. You have a fast moving average and you have a slow moving average. In this particular example, the fast moving average is a 14-bar moving average, and the slow moving average is a 20-bar moving average. And you see, as soon as the 14-bar moving averages crosses the 20-bar moving average from above, this is a sell signal that is actually triggered here on the 6th bar on the left-hand side. And you would then buy back as soon as the 14-bar moving averages crosses the 20-bar moving average from below. This is a buy signal. Again, these kind of strategies work in trending markets. So only apply them in trending markets, because if you apply this strategy in a sideways moving market, you are getting whipsawed and you start losing money. Very important. Now you can play around. 14 and 20 bar is very popular. Also, I think it's 718, 918 as crossover pairs. And if you have a trading or a charting platform that allows you to program these strategies, you can play around with this and basically see what combination gives you the best results. Just make sure that you're not over optimizing a system, and we'll talk about this here in the 7th step. Now, another example for a trend following approach is the MACD, the moving average, convergence, and divergence. And basically what the MACD is, it is a difference between two moving averages. So this concept is based on the crossover of moving averages. And so the MACD, the blue line here, is actually the difference between a slow moving average and the fast moving average. And the standard settings for this is, as you can see here on the screen, 12 and 26. So you're using 12 for the fast moving average and 26 for the slow moving average. And the blue line is already the difference between these two moving averages. Now, another little twist here, the moving averages are exponential moving averages. But this is what your charting software already includes in there. Now, you also see that you have a purple line here. Now, the purple line is an exponential moving average of the MACD. So just to twist your brain a little bit, there's an exponential moving average of the difference between two exponential moving averages. Got that? Doesn't matter. This is why we are recording it, that you can listen to it later on and you can read all this information. It's freely available on the internet. Just look up MACD, a good site actually for defining all these indicators and how to use them. It's investopedia.com. So you might find something there. And the moderator might correct me here if FX Street also has indicators and the explanation of indicators now on the side. Last time I checked, I haven't seen it, but I know that FX Street is doing a tremendous job of constantly adding more and more content, making it your premier source of information. Ray's asking why 12 and 26. Well, these are the standard settings, Ray. I don't know who came up with this. I think the MACD was developed by Gerald Apple. And the last thing I heard that Gerald Apple is right now somewhere in New Zealand or Australia hiking. So, I mean, he's no longer active. I tried to contact him a couple of weeks ago and see how he's doing, and I just heard from his company, nah, he's no longer active. Gerald Apple is somewhere in New Zealand or Australia. That's the last thing I heard from him. Okay, again, you can play around with it, but you see the very simple rules. Usually, originally, how the MACD or the strategy based on the MACD was defined is you buy as soon as you see the MACD crossing its moving average from below. So as soon as you see the blue line crossing the purple line from below, you get a buy signal. You see, you hold it until you see actually the MACD crossing the purple line, its moving average from above. And again, this is something that works in a trending market. Now, the way how I like to use the MACD, and those of you who have attended previous webinars of me where I presented trading strategy based on MACD and Bollinger Bands know that I like to add a little twist to it. I'm using exactly the same settings, but I want to see that the blue line, the MACD, is above its zero line. And let me just bring up an arrow here. So you see the crosshairs. This is basically here towards the middle. It is a more conservative approach if you wait until the MACD is above the zero line. A more aggressive approach would be if you just wait for a simple crossover here. All right. So this is the MACD. This is another popular approach. Again, only works in trending markets. Let's move on to trend fading indicators. And this is where you have Bollinger Bands as a trend fading indicator in a market that is going sideways. Now, in a market that is going sideways, the Bollinger Bands consists of a center line, which is a moving average, and typically there's a standard setting of 18 to 21 used for the moving average. And then you see a blue dotted line below and above the moving average. So these are the standard deviations. And the standard settings here are 2 standard deviations. Now, when you see that the Bollinger Bands are flat, basically just moving sideways, this is when you know that you're in a sideways moving market. And in this case, you want to sell as soon as prices move outside of the Bollinger Band, and you want to buy back when prices are then touching the lower Bollinger Band. In a sideways moving market, you will see that prices tend to move from the upper band to the lower band. A more conservative approach is to sell at the upper band and buy back at the moving average, and then wait until prices touching the lower band, buy and sell when they're hitting the moving average. See, this would be more conservatively, and of course you can apply some profit-taking exits to this and saying that you take half of your position out as soon as prices are moving back towards the moving average here, and you take the remaining of your position out as soon as it touches the other band and move your stop to break even. See, this is where exit points come in for another very important step here, and we'll spend a couple of minutes here also on exit points in a little bit. However, note that whenever a market starts trending and when the Bollinger Bands are turning down or up, you will see that Bollinger Bands are leading the prices. So Bollinger Bands, again, are a hybrid trading strategy that can be used for trend following. In this case, the Bollinger Bands start to head in one direction, either down, or in an uptrend, the upper band will head up. Only apply this strategy to sell and to buy when the Bollinger Bands are flat and just moving sideways, especially if you see, for example, if you see that the moving average is moving sideways. As soon as the moving average starts pointing up or down, this is when usually the market starts trending, and that is when you move from a fading system to a trend following strategy. Do not keep blindly trading this year and you keep just buying at the lower band when you see that now the market is trending down. I mean, you experience a horrible drawdown. Be smart, okay? So this is why we still need human traders here. All right. Now, entry rules as a conclusion. If you apply trend following trading strategies, the time frame should be at least 15 minutes, better 60 minutes. And here's why. These days in the markets, we have a lot of noise that is caused by scalpers, that is caused by computerized trading, and also by hedge funds. So on smaller time frame, within 15 minutes, you'll see a lot of manipulated, engineered moves, no true trends. You can only catch true trends if your time frame is at least 10 or 15 minutes. This is why I recommend it is easier for you to see whether a market is moving if you have a time frame of at least 15 or 60 minutes. In trend following trading strategies, you have typically a larger profit target than a stop loss. So you might have a stop loss of $100, and in this case, you would apply a profit target of $150, $200, or even $250. And I recently wrote a blog entry about this, so if you also visit my website, you'll see that usually I'm posting a blog entry at least 3 times a week, where it talked about it, that the winning percentage is actually a function of the ratio between stop loss and profit target. You see, the higher this ratio, so if, for example, you go for a $100 stop loss and you want to have a $500 profit target, so the ratio here is 5 to 1. In this case, your winning percentage will drop down. Still, you will probably be profitable because if you win big. However, if you drop down to a smaller ratio like 1 to 1.5, 1 to 2, your winning percentage increases. And this is when we also move here to trend fading systems. Trend fading systems, I think they're great for beginners. It's great to get your feet wet. You will not get rich on trend fading systems, but it gives you an idea, gives you the mechanics. You can trade it on rather small time frames. You should be making small and consistent profits. Your winning percentage on trend fading systems is typically anywhere around 70 to 85%. So this is very good for a beginner because you're right most of the time, which is good for your confidence. And we talked about this in last month's webinar. Confidence is so important when you're trading. Confidence in you as a trader and confidence in your trading strategy. And keep in mind that markets are only trending 20% of the time, so you will have more opportunities if you apply a trend fading approach. However, once you have it down, I strongly recommend that you move to trend following because that is where the money is. And for those of you who have read this fantastic book from Jesse Livermore, Reminiscences of a Stock Operator, or actually it was written by Edwin Levere, but it is about Jesse Livermore, the fantastic trader who lived 1900 something and then put a gun in his mouth after he lost a lot. I mean, he always said it, that trend is your friend. And this is true until today. And you will see if you also read the interviews of other successful traders in, for example, Jack Schwager's excellent book, Market Wizards, you'll see that usually they're all applying trend following strategies. All right, let's move on to exit signals. So this is the fifth step, exit signals. So you have basically two types of exits. First is a stop loss to get out if the market goes against you, and you should have profit targets. You realize profits if the markets move in your favor. Good traders have a stop loss in the market. Great traders have a profit target. Now, why would you limit your profits? I mean, this is a question that I always get and say, why do you limit your profits? Guys, you need to understand one thing. Nobody ever got broke taking profits off the table. And especially these days, where markets have changed, where markets are more volatile than ever, you want to take your money off the market as soon as you can, before it turns around, because the markets can turn on a dime. Also, it will help you controlling your emotions, because if you don't have a profit target in the market, you might get greedy. So you already see $150, $200. So you already see maybe 20 pips in a trade, and you thought, oh, yeah, that's great. Then you see a little retracement. Markets retrace or correct to 16 pips, so you have a profit of 16 pips or 15 pips. And then it keeps correcting, and you say, oh, no, I want them to go up to 20 pips again. I already saw 20 pips in here. But the market keeps correcting, and you might get stopped out at break even and never shows you the 20 pips profit again. Make sure that you take your money as soon as you have it. Now, the third type of exit is a time stop. Very, very important. You want to get out of the market, out of a trade, if the market does not move at all. Don't gamble. Let me give you an example. Let's assume that you're applying a trend following strategy. Let's assume that you say you want to buy the breakout of the previous day high, because you're assuming that then the market will keep going up. So you wait for your chance and you buy stop order in the market, and prices are approaching the previous day high, and bang, you're getting filled. And now the market is hovering around the previous day high. It's not really going up, it's not really going down. Neither your profit target nor your stop loss is being hit for 5 minutes, for 10 minutes, for 15 minutes. What should you do? Get out of the market, because now it becomes a gamble. Your underlying assumption was that once prices move up to the previous day high, that then they quickly break through and that you see some momentum. You don't see some momentum. So as a rule of thumb, I would say 3 times the time frame that you're trading in, and you should get out of the trade. So if you're trading on 5-minute bars, if you're still in the trade after 15 minutes, 3 times 5, get out of the trade. If you're trading on 60-minute bars and you're still in the trade after 3 hours, get out of the trade. If you're trading on daily charts and you're still in the trade after 3 days and it has neither hit no profit target nor your stop loss, get out, because from now on it becomes a gamble. So, what are exit rules that you can apply to both profit targets and stop losses? You can take a fixed dollar amount. This is probably the most popular approach, where you say you have a fixed amount of dollars or pips that you take out of the market. You could take a percentage of the current price, and I have some examples here on the next couple of slides. You could take a percentage of the volatility, for example, 50% of the average daily movement, and of course the time stop you always specify in minutes, hours, or days. So let's take a look at some examples here. Here you see the stop loss as a percentage of the current price. Oh, there's a word missing. For example, you see here that the entry price, and we're looking at the chart of the E-mini Nasdaq, but you can apply this to any market. The entry price was 2,151 3/4. Let's assume that you want to apply a stop loss of 0.5% In this case, you would just take the entry price, multiply it by 1 minus 0.5%, and you arrive at a stop loss of 2,141. Now, this approach is very popular for stock traders because they constantly trade stocks at different prices. You see, they might trade stocks that are trading at $5, and they might trade stocks that are trading at $100. So you cannot use a fixed dollar amount. If you would apply a $1 stop loss to the $5 stock, this would mean that in percentages, you would apply a 20% stop loss. On the other hand, if you're applying a $1 stop loss to a $100 stock, this would be only 1%. You see, this is why stock traders usually use a stop loss as a percentage of the current price. Now, what I personally like to do is using a volatility-based stop. Now, in a volatility-based stop, you see, if you have high volatility, you will have a larger stop loss, and if you have low volatility, as you see here on the chart, you'll have a smaller stop loss. So as an example, and I've presented this in the previous webinars, I like to set a profit target of, for example, 30% of the average daily range and the stop loss at 20% of the average daily range. So this way you adjust your stop to market conditions. If the market becomes more volatile, use wider stops and also wider profit targets. And if markets become less volatile, use a smaller stop loss and therefore also a smaller profit target. Okay, and CVJ is making an important point. Variance is crucial to all positions. One must adjust their lot size and exposure to specific criteria of this specific trade. One size does not fit all in that case. You're absolutely right. And this is CVJ where money management comes into play. Money management tells you how much money you want to risk overall on the trade and therefore determining your position size here. This is money management, an important concept. Today we won't have time to go into money management, but this is the basic question that money management answers. How many positions or how big of a position should I trade, okay, on every single trade? Very important. Good comment here. Very good comment, CVJ. Thank you. All right. Now, many traders also like to use technical analysis to apply some stops. For example, you see that we have 15-minute bars here. You see these vertical lines, and the vertical lines are denoting the beginning of trading and the end of trading. So one might say, since we had a gap opening here, that you want to sell immediately as soon as the market is opening. So in this case, you might use that as your stop loss, okay? Now, the market goes all the way down, and then you see we have a low here. So we might determine another stop or profit target at that level. Now, if you trade on the next market and you see the first bar of the day here, first bar of trading is an up bar, and there are some trading strategies that say, well, if the first 15-minute bar is closing higher than it opens, then you want to buy. In this case, you want to sell as soon as it approaches the previous day high. And you might even reverse the position and then take profits again at the previous day low. So you see, previous day high and previous day low give you some excellent profit targets and stop loss in the markets here. All right. We need to move on. We have approximately another 7 minutes, and we have a few more slides that we want to cover here. This is another example for a trailing stop, very popular, and a trailing stop is actually a hybrid stop. A trailing stop at first is a stop loss, and then it becomes a profit target. See, if you're going short here at the first bar, many traders like to place a stop loss at the high of the current bar, and then keep trailing it at every bar until you're getting stopped out here. Make sense? Well, so in order to keep it simple, you might want to use a fixed dollar amount or a fixed amount of pips in the very beginning if you start trading. You could also use percentage stops, and the best that you want to use is volatility stops, because as you said, you'll have wider stops in volatile markets and tighter stops in quiet markets. Always use time stops. Get out if the market is not moving. Take the next opportunity. Free the capital. The markets are providing us countless opportunities here. So no problem whatsoever getting out of a trade, getting out with a small profit or a small loss, and wait for the next opportunity here. Let's move on to the sixth step. step. Gosh, that is difficult. Can somebody say this? Is it just me as a foreigner who has problems with the sixth step? All right, you know what I mean. Step number 6, that's better. Evaluating your system. Now, you could either keep an Excel sheet and based on this Excel sheet, log all these trading logs, which I ask my students to do, and therefore then calculate your performance report. Or if you have sophisticated software that allows you to program your trading strategy, you might get a performance report like that. Now, what is important when you read a performance report? And unfortunately, the biggest problem that traders make is they only look at the net profit and the winning percentage. And hey, as long as the net profit and winning percentage is high, we are in business. This is good trading strategy. No, not necessarily. There are a few more things, and they're very important that you know about them. For example, what is the average profit per trade, especially if you're trading in markets where you pay commissions, like the futures and the stock market. You want to make sure that the average profit per trade is large enough to cover your commission. So as an example, if you are paying $8 in commissions if you are trading the futures market and the average profit per trade is $9, all you would have left is just $1. Also in the Forex markets, you want to make sure that the average profit per trade is covering the spread that you're paying in the market. See, for the liquid markets and for the popular markets, you might pay a 2-pip spread, but for more exotic markets, you might go up to 3, 4, or even a 5-pip spread. So make sure that the average profit per trade is large enough to cover the commission and or the spread. Now you want to take a look at the profit factor that is in the upper right here. And you see a good profit factor is anywhere between 1.3 and 2.5. If you see a profit factor that is bigger than 3, then you probably have an overpriced and curve-fitted system. And you want to avoid this. So you want to double check and triple check if everything that you did is really working. Now, the average trade and trades per year. How many trading opportunities do you get per year, per month, per week? See, if you're an active trader, if you want to have 20 trades per week, but your trading strategy is just giving you 1 or 2, then this trading strategy is not for you because you won't probably not have the discipline to follow the trading strategy because you're looking for more action. What is the maximum drawdown? Very important to determining your account size. And also, how many consecutive losses in a row does this trading strategy produce? Because you see, if this trading strategy would produce like 10 or 12 consecutive losses in a row, do you really think you would have the confidence and the discipline to place another trade after 7 or 8 consecutive losses in a row? Most traders like to see anywhere between 4 and 6 consecutive losses in a row just to make sure that you're not losing your confidence. And as I said, confidence, very important when it comes to trading. Confidence in you as a trader and in your trading strategy. Peter is asking, where's a good place to find common trading strategies? As I said, there are excellent books out there. For example, Thomas Stritzman has written books on trading strategies and money management. James Altucher has written a book with 21 trading strategies, and you'll find it on many forums on the internet. Usually forums have a section about free trading strategies where you find the most common approaches. Just use them as ideas. Do your own testing. TradeToWin.com, EliteTrader.com. So these are forums where you find a couple of trading strategies. I think MoneyTech.com might be another forum. Just look around and look for trading strategies. And also in the books and these magazines are another great source. So if you're subscribing to Active Trader or Stocks and Commodities, for example, see, it doesn't really matter whether it's called Stocks and Commodities and you're trading Forex. A good trading strategy you can apply to all markets, whether it's stocks, futures, or Forex. That's the beauty about a good trading strategy, okay? It works in any market, and it should work in any time frame. This brings me actually to the next point here on the next slide about improving the trading strategy and testing it on multiple markets. What did I do? Here's what I do. When improving your system, make sure that you don't curve fit it. And this is what, unfortunately, many traders do. And moderator, just a heads up, yes, I'll be done in 5 minutes. So I'm already at step 7. This is the last step that we are having here. I have 3 more slides. So we will be done here on time. Make sure that you don't curve it. With today's powerful software, you get reports that, for example, you see, well, the trading strategy is doing great, except on Thursdays. And so you start adding a filter that says, well, I don't want to trade on Thursdays. And then you look at the performance reports again, and it says, well, on the 12th day of the month, it is not performing well. You don't know why, but you eliminate this. So you're adding one more filter. You see, you keep doing and doing this until you add more and more filter. And what happens is you filter out all the losing trades of the past. Extremely dangerous. Don't do that. What you want to do, why do I keep coming back to this slide here? Okay. A good way to improve your system is to add profit exits if you don't have any profit exits. You want to add stops, especially time stops. You want to modify stops. You want to try a trailing stop versus a hard dollar stop. You want to use a volatility stop versus dollar stops. And consider the system characteristics. If you do have a trend fading system, don't trade on days when you know the market will move. For example, when the US GDP is being released or unemployment rate first Friday of the month, or when Bernanke is speaking and you know that this will move the market. Don't trade then. So these are very important improvements that you can make to your system. And always test it on multiple markets. That is the ultimate test to see whether you have whether you have a curve-fitted system or not. If you have developed a strategy or system that works well in the US dollar versus the euro, it should work equally well in the US dollar versus British pound and maybe on a related market like the Canadian dollar versus British pound and so on. It'll be a great system if this would also work on the stock indices, so in unrelated markets. But make sure that at least in related markets it works, otherwise you have curve-fitted the system to a particular market. All right. Today we talked about the 7 steps how to develop a profitable trading strategy. In our next session, the first Tuesday in September, we will use the steps and actually develop a trading strategy. This so that you see how we walk through all these steps. So today, definitely, I hope if you're taking notes right now, quickly take some notes. These are the 7 steps. And you want to go through them one by one. Don't do all the steps at once because it might be overwhelming. First, start with an idea. You select a market, a time frame, define your entry and exit rules, evaluate your system, and if you're not happy with the results, then do not throw out the whole trading system. Go back, change the exit rules. If you're still unhappy, then go back one further step and modify your entry rules. Maybe add some additional filters. If this still doesn't produce the results, change the time frame. I've seen many trading strategies that did not work on 15 minutes but worked perfectly on 60-minute charts. So play around with that. If this still doesn't work, change the market. If you have been trying to develop a system in the euro versus the dollar, you might want to port the system and just transfer it to the E-minis, for example, E-mini Dow or E-mini S&P, E-mini Nasdaq. And you might see that suddenly a trading strategy that is not successful on the currency market is successful in the stock indices. Again, it depends whether you have a trending market or a non-trending market. All right, guys, it is your future. And Albert Einstein supposedly said the definition of insanity is doing the same thing over and over again and expect different results. If you want to experience different results, you have to do something different. So I encourage you right now, do not just sit here and listen to me, and I know might be fun. Do something. Take action now. On our website at rockwelltrading.com, we have a free software tool called the Trading Plan Generator, walking you through 8 steps. It is not generating a trading plan for you magically, but it is asking you, okay, what are the markets you want to trade? What is the time frame? So basically, all the 7 steps that we covered here today, it is walking you through a set of structured questions so that at the end, you have a well-defined trading plan. So I strongly encourage you to go to our website right now because we are closing here in the next 2 minutes if there are no further questions. Go to rockwelltrading.com, download this trading plan generator and start doing something. Take action now, otherwise nothing will change. All right. We have the next presenter coming up here, so we have to empty the room here. I again want to thank fx3.com for having me here today. fx3.com, your premier source of information and education around Forex and related markets. It's always a pleasure to be here. It's a great and fantastic crowd that we have in these webinars here. And guys, and as I said in the very beginning, I'm here in South Padre Island, sitting on the beach. I'm looking at the ocean right now, and it is calling me. So I'm getting out of the car here right now, and we'll jump right into. I wish you all a wonderful day, and I'll see the premium guys. For those of you who subscribe to the premium services of fx3.com, I'll see you in between, and all of you, I hope to see you on the first Tuesday of September. Yes, so we have, I think is Derek coming up here? I think this is the next speaker. Thank you very much. You enjoy. Bye-bye.